Go ahead, Paulo.
Thank you, Maria. Congratulations. Very interesting presentation. In Brazil, we're not there here, but we're going the same direction. Well, we can say that the Brazilian mining tax regime is mostly based, also as Chile, on income taxation and on a royalty system. And that is because there is no VAT levied on exports in Brazil. So mostly these are the two main taxes, let's say, that levies on the mining industry. So starting with the income tax, there are some alternative taxation regimes in the country, but in general, mid-size and large companies are all taxed at a nominal rate of 34%, which levies on fiscal profit, and that is an accounting profit after going through certain adjustments. The Brazilian nominal rate, as you see, is very high. It's the 5th highest in the world, and that naturally leads to an economic incentive for tax planning, especially in the international level. And that tax planning usually relates to thin capitalization and transfer pricing. And unlike Chile, which Maria just told us has a tax benefit of accelerated depreciation for mining, there are no specific incentives on corporate income tax for mining in Brazil, okay? But there are incentives for business projects in the poorest regions of the country, notably north and northeast regions, as you can see in the map, which can lead to a reduction in the effective income tax rate to something like 15%, a bit less, a bit more, okay? And this is a point of attention regarding the BEPS Pillar 2, which deals with the global minimum tax, as there is some doubt whether these tax incentives, which aims at the development of these poor regions and fulfilling a specific rule in the Brazilian Constitution, could have its effectiveness minimized by some rules that arises from international tax treaties. Okay, so we don't know if BEPS Pillar 2 will have some kind of rule that affects this effective tax rate, which is really low for the Brazilian nominal rate perspective. And about foreign investments in mining, those two projected figures illustrate both the debt instrument and equity financing, okay? So starting with equity, we have a difference in relation to the Chilean model. The Brazilian system brings total fiscal neutrality to the model by not taxing dividends at all. But we are also prohibited to deduct the payment of dividends in corporate income tax. So it's neutral. Another difference is that taxation, there is a taxation of foreign direct investment by a tax in Brazil that is called IOF, which is the Brazilian tax levied on financial transactions such as exchange transactions, and that is levied at 0.38%. There's also an incentive to the tax deductibility of the goodwill that is normally registered in the Brazilian holding company if it makes an acquisition with unrelated third parties. And that point is very relevant in Brazil from a financial point of view, because in general, goodwill has a high value in these kind of transactions, and is also a matter very disputed among the IRS, the Brazilian Receita Federal, especially because this Brazilian holdco that is projected usually is understood by the IRS just as a vehicle of the investment. And so IRS usually states that it doesn't have any substance, and in that regard, it couldn't deduct any goodwill. Okay, so that structure is very, very important when you talk about financing a mining project by equity in Brazil. The investment model for debt instruments, of course, is not neutral, although the remittance of money here is not taxed by the IOF, differently from the equity model, okay? Interest payments to the foreign investor are taxable at 15% withholding tax. And as Maria said, in Brazil, we also had that same reality. Depending on the investor's country, that withholding tax may be deductible because of the double tax treaties, okay? But these withholding taxes must be economically confronted with a possibility to deduct the payment of interests to the foreign investor at 34%. Okay, so what we have here, an incentive for thin capitalization, right? And that is why in Brazil we have thin capitalization rules that do not prevent this kind of tax planning, right? So this is a very common model to finance mining projects in Brazil. Usually they are mostly financed by debt instruments. Mm-hmm. And this is being closely watched by the OECD with other institutes such as the IGF in the debates that are going on due to the BEPS project, okay? You can pass to the next slide, Maria. As for royalties, the Brazilian constitution says that only the federal union could create them, okay? However, due to this resource nationalism that we're talking about, as of 2011, several Brazilian states are starting to create their own mineral royalties, okay? So the federal royalties are almost entirely transferred to the states and municipalities in the proportion that is indicated on the slide, which makes them very important instruments for the development of the local mining activities states, you know. And they're levied both on the sale of the ore or on its industrial transformation that is called ore consumption by the Brazilian law. In the first case, the calculation basis is gross revenue less taxes. And in the second, it can be a value fixed by the government, by the National Mining Agency, calculated on the cost of production or on the market value of the ore. The rates, as you can see, vary from 1 to 3.5%, depending on the type of the mineral. The highest rate being on iron ore for the reason that this is the most lucrative business in mining projects in Brazil. And the standard rate is 2%, okay? State royalties, on the other hand, are not levied on revenue, they're levied on volume. They're unit-based royalties. And the states actually collect more from these royalties than from the transfer from their share of federal royalties. Therefore, we have great expectation around the judgment that the Supreme Court will make regarding the validity of these states' royalties. And you can go to the next slide, Maria. The federal royalty model that I just presented to you was defined by this law, 13540 from 2017, which is a recent law that has increased the federal royalty in a significantly way. As you can see from 2017 and beyond that, the collection of this royalty has more than doubled. And this law is also under judicial dispute regarding its validity. Although these state royalties and the 2017 law, as I said, are already some instruments that characterize what we're saying here about resource nationalism, we have several other important bills on the way in Brazil, such as Bill 2337 from this year that was greatly debated by tax lawyers and the tax academics in general, that intended to reduce the income tax rate from 34 to 26%, because, as I said, Brazil has the 5th highest nominal tax rate in the world. And on the other hand, the project intended to tax dividends remitted abroad, as Chile does, as well as increasing the federal royalty by 1.5%. This bill actually was approved by the chamber this year, but it was rejected by the Senate in November. And since the bill was rejected by the Senate, and there is a great appeal, as we know, in the National Congress to increase the tax burden on mining, this bill 4199 was presented at the end of November, on the 29th, which conveys the same proposal to increase the royalties by 1.5%. We think here that the chance of approval of this bill 4199 is moderate, because at some point the mining companies know that there will be another raise in federal royalties. And there are also proposals to revoke the state VAT immunity on mineral exports. We have a remote chance of approval. They are all the time in the political debate, but there is a consensus that this is not going to be approved. And unlike Chile, there are no projects in Brazil related to fiscal stabilization agreements and variability agreements. And I think this instrument could be very interesting for Brazil to provide greater legal certainty to investors, considering that the Brazilian tax burden is already very high, as we saw. And although we do not have these instruments here in Brazil, we have a legal dispute that is kind of similar, that could lead to a similar effect, actually, regarding exclusively the federal royalties that were increased in 2017, as I said. Miners defend that the new law could only apply to future mining concessions because of the principle of legal certainty. And that is a practical way to say that there is like a fiscal stabilization because of the concessions that are prior to the new law. So these are my considerations. Maria, if you want to comment something else, feel free. And I appreciate everyone's attention.